of that AI revolution into, let's call it, small caps. And that's why I actually think the valuation anomaly might actually be in the smaller cap space, which basically has been overlooked for years now.
So this is the argument that people were making last year that didn't really come to pass, that we'd see a broadening out away from the hyperscalers and the big tech names to the rest of the index, because you are seeing that diffusion of some of the tech prowess. Is that sort of what you're expecting now? Is that kind of where you're leaning in?
It is. And also, let's not forget, like, breadth this year has been pretty good. So we've already seen a broadening out. Like, best performing sectors in 2025 have actually been things like industrials. It hasn't necessarily been just the mega caps. But then we've also got to start thinking about a regime shift, which has already been discussed in this forum here, which is, what are the Fed going to do? If we're going to move away from a higher for longer narrative to a lower interest rate environment, consider the fact that small caps, 45% of small caps are variable interest rate debt. They're going to get the direct benefit of interest rate cuts. So we can pontificate about whether Mr. Powell is going to resign or the rest of it, and we will. However, the fact of the matter is that we will end up with a replaced Fed chair at this time next year, and we are pretty convinced that the path of interest rates is therefore lower. So we need to think about less about the near term and more about, if interest rates are lower, who's going to be the direct beneficiary? So it's not just the AI angle. You've got lower interest rates, and you've also got the positioning, which has been our guiding light since the beginning of June. From a positioning perspective, look at CFTC data on small caps. It's currently the most short since last summer, right before we had that big squeeze as well.
Even before we get a new Fed chair, we could see the Fed cutting interest rates. When do you have this all timed out?
Well, so Barclays economists have still two cuts for the year. So, September, December. I think that at the end of the day, whether this is one cut, two cuts in 2025, I wouldn't say it's irrelevant, but I would say it's marginal, because we're trying to sort of forecast. Remember, equities are supposed to be a forward discounting mechanism. They're supposed to be thinking 6, 12, 2 years out, especially for long-dated securities that don't have many profits today. So in that case, I don't think it matters enormously.
So for small caps, you want to be exposed ahead of September?
Correct, yes. I think the small cap story is really not just about positioning, but it's about that Fed pivot, or dare I say, is the equity market moving into a new regime, away from just thinking about the narrowness of leadership and into something a little bit more broad.
Strange things happen in August. Are you hopeful we'll have one of those nice quiet summers?
I mean, I'm going on vacation on Friday.
You're taking some time off.
Yeah, I would very much hope so. But as you say,
nice
August is notoriously volatile. August can be notoriously volatile. If we all recall last year what happened with the BOJ and so on and so forth. I would say that the fact is, we still, to your first question, we still have that confluence of events straddling month end, and any of those could potentially derail this low vol environment.
What's volume like at the moment? Just volume?
Volume, well, volume is okay, but it's massively skewed by the retail cohort. So we're seeing this enormous turnover within a small number of securities as a function of the small investor, which is, again, a part of a larger discussion.
Can I just follow up on that? What securities? Are they concentrated in the ones we talk about every day, or different kind of companies?
I mean, just for the purpose, I won't name specific names,
sure.
But I'll give you an example that I think it was middle of last week, 4 securities accounted for 11% of total NYSE volume. The collective market cap of those 4 was 2.6 basis points of US capitalization. So these aren't stocks that you talk about on a daily basis.
11% of volume, 2.6 basis points of market cap.
Yes. Of US market cap.
That's amazing.
Yes.
Have you ever seen it like that before?
We have not, no.
What do you think's behind that? So
that is, I would say, retail euphoria. So you've had this prevalence on shift of obviously a multi-year structural phenomenon post-COVID, where small investors have become a larger and larger portion of the tape. They now account for about 25%. Systematic flows, so quantitative flows, account for another 50%. And those numbers have just been growing over time. So the only time we came close to this was in 2021, obviously a very different real rate environment.
But different backdrop completely. So I'm trying to figure out, just in real time, what's unleashed this recent bout? Because it feels like a very different backdrop to where we were all those years ago.
This goes back to my point of whether are we in a bubble or not, because we're talking about animal spirits, we're talking about euphoria, we're talking about the fact that there's a lot of small investors still haven't lost their jobs, still getting income growth, still basically seeing the stock market at the highs. And if you remember at the beginning of the year when we spoke on this show, there's a reflexivity in stocks. Because the economy is so financialized, 70% of financial household net worth is tied to the stock market. So on the way down, it feels terrible. On the way up, it feels fantastic.
Is this stupid money or is this smart money? Because they've been the winners. And a lot of people used to dismiss this and say it's a bubble and this means that the market's going to tank. Are people looking at this and saying this means there are more gains ahead?
Well, I don't want to call them stupid money because the fact of the matter is they've made more money than most professional investors have recently. I would just simply say that these guys are doing what they've been doing or conditioned to do, which is buy the dip. I think what's important to consider, though, is back to this regime shift. Is the market telling us that we're moving to a lower interest rate environment where actually it's a lot of the less profitable stocks that end up being the market leaders? And if you look at things like certain factor behaviors, the only time we've seen this before, what we engineered as a short squeeze, but it's not a short squeeze, 2009, 2020 and 2021, neither of which were just short squeezes. They were regime changes. And so I think that's what we're pointing towards. That's why we're thinking about small caps more, because it may not just be the stupid small investor. It may actually be something a little bit more paradigmy.
Those numbers are amazing. 11% of volume across 4 names, which account for 2.6 basis points of US market cap.
Yeah.
Unreal. Alex, good to see you.
Nice to see
you. A lot to
you.
think about. Thank you. Thank you, sir. Alex Altman there of Barclays. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara. Hey, Yahara.
Hi, John. Treasury Secretary Scott Bessent is calling for an exhaustive review of the Fed's non-monetary policy operations, including the $2.5 billion renovation of its headquarters. In a post on X, Bessent says that significant mission creep may be jeopardizing the independence of the central bank's core mission to set monetary policy. Meanwhile, the Trump administration released more than 6,000 documents related to the 1968 assassination of Martin Luther King Jr. yesterday, despite opposition from his family. The digital data dump includes more than 240,000 pages that had been under a court-imposed seal since 1977. In a statement, King's 2 living children urged the files be viewed within their full historical context. And In-N-Out's billionaire heiress Lindsay Snyder is leaving California for Tennessee. She said both raising a family and doing business in the state is not easy. Snyder said the burger joint still wants to keep a small footprint, and despite growing calls, she says In-N-Out won't be expanding to the East Coast. A bummer for us. That's your Bloomberg brief. John?
She's out. There we go. Yahara, appreciate it. Thank you. That was terrible, wasn't it?
That was so bad.
Up next, the Morning Calls Plus. Nishit Matlani of S&P Global reacting to GM earnings. That conversation up next.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, yet ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
We're concerned about earnings. You know, we're scheduled to do what? Low, middle, single digits here this quarter on EPS growth. That's going to be the lowest in about 1.5 to 2 years. If corporations can't hold those margins up, y'all were just talking about the margins from Coca-Cola. We saw margins go down with GM. I think you start to see some of that flow through to the consumer, and you see that weakening in the economy.
That was Victoria Fernandez across Mark. The latest on the earnings. More earnings coming up a little bit later. We'll hear from Alphabet and Tesla tomorrow. Equity futures so far just about unchanged on the S&P 500, negative by 1/10% on the Nasdaq. Alex Sullivan of Barclays just moments ago talking about volume. 11% of volume driven by 4 names. Those 4 names make up 2.6 basis points of US market cap. They are not the names you're thinking of.
They are tiny, they are specific, they are the Reddit posts, etc. But his takeaway from that was really interesting. It highlights the animal spirits and it highlights the conditioning of retail investors buying the dip. And does this indicate a sea change, a paradigm shift, not necessarily dumb money, but sort of a smart take on where things are going and a potential harbinger of more gains ahead?
Record highs coming into Tuesday. Let's get you some morning calls. First up, JP Morgan cutting Lulu to neutral, citing a more cautious and discerning consumer. That stock is down by 1.2%. Your second call from Stifel, raising its price target on Alphabet to 218, seeing upside to the company's estimates. And finally, Citi, raising its price target on Amazon to 265, expecting revenue and operating income to top Wall Street estimates. That stock is higher by about 1/3%. Let's turn back to earnings. GM, seeing a blow from President Trump's tariffs, a big number from that company earlier on this morning. GM is down by 3%. With the details, let's cross over to Bloomberg's Ed Ludlow. Ed, not a great number from that company.
No, but it's the immediate and quantifiable impact of tariffs. So it's a $1.1 billion hit to adjusted earnings, bearing in mind the short period of time that they've had this exposure in time to do the math, and actually over the range of an annual basis, they see it in the range of 4 to 5 billion. And so GM, like every other industrial American company with exposure to a supply chain that ranges from Mexico to parts of Europe and Southeast Asia, is doing what it calls mitigation. But as you see the stock down 3%, John, this is a story where it actually beat expectations in large part of what was baked in, but profit is taking a real beating from policy, and you can't shy away from that.
Ed, of the big 3 in Detroit plus Tesla, who's in a more vulnerable position here in the face of these tariffs?
The big 3 more so than Tesla. I mean, the way that Tesla's always put it is that it's the least exposed to tariffs because of the concentration of supply chain in North America, particularly the USA. However, Mexico is still an issue for Tesla, right? 20 to 25% of components come from that nation. And the way that Elon Musk put it on the last earnings call is tariffs are hard when margins are already low. Tesla, of course, has historically had industry-leading margins. If you call it an automaker, you know, of course, we can debate whether it's valued as a tech company and its future in AI and robotics. But at the end of the day, they're still going to feel a bite, just less so than the Detroit 3.
Ed, appreciate the update. Looking forward to the programme a little bit later. Ed Ludlow alongside Caroline Hyde at 11 a.m. for Bloomberg Technology, about 3 hours away. Joining us now to extend the conversation, Nishit Madlani of S&P Global Ratings. Nishit, welcome to the programme, sir. Let's just talk about the kind of mitigation strategies these companies have introduced over the past few months. What are they doing to navigate the storm?
Yeah, first of all, thanks for having me. Look, like you said, I mean, there's been lots of uncertainty, especially around March and April around tariffs, shifts in trade policy. It just weakens consumer sentiment, and it's created volume volatility. So what they can do, you know, just is specific to companies like GM, where tariff cost mitigation is very important to offset the 4 to 5 billion impact that they're expected to have. So things they can do is try and leverage the duplicative capacity they have. So, for example, they've decided to relocate some of their pickups to Fort Wayne, localize production of their battery modules, and just ensure that they have better supply management, because there are suppliers and internal facilities here that can be utilized better within the U.S.
How much can they automate some of this to offset some of the higher costs of labor in the United States? So bring more manufacturing back to the United States and have more robots essentially in the factories.
Yeah, so that's something they haven't quantified, but it's certainly part of the playbook, right? If you look at what's happened in terms of manufacturing efficiency across companies, there has been increasing use of automation. Not to the same scale as Tesla, but it is certainly catching up. And of course, with the moves announced by them in terms of improving their utilization, that's the first step, because by adding about 300,000 units of additional pickup truck capacity within the US, that just helps overall utilization as well.
This raises a question of how they invest in some of the production and moving production to the United States to get around tariffs, while also cutting costs to offset some of the hit that they're seeing from those extra levies. How do you expect them to do this?
Yeah, look, this is one thing where we have a lot of credibility that we've assigned to the company's management team. They have a solid team, great track record, and despite external shocks, they've maintained a lot of discipline in achieving their targets, whether it's pricing or just making sure that inventories are not overbuilt. On a cost standpoint, look, they've mitigated all kinds of cost headwinds through their internal efficiencies. They've made sure that they're not over-engineered. They also ensure that from a supply chain perspective, they're less exposed to bottlenecks that seem to be more of a common issue for their peers versus them. So I think overall, just a better handle of overall execution from the management team.
Are they at some point going to need to raise prices, though, of their auto vehicles?
Yes, I'd say, look, that's inevitable, right? I mean, if you look at the way they've quantified the impact of prices, 0.5 to 1% type increase, we think that going forward over the next couple of quarters with the pressure that the consumer is facing, it's going to be hard to maintain something more than that. But at the same time, GM, Stellantis, Volvo Car, those are the ones that have the largest cost exposure. So our expectation is that we probably won't be surprised to see low single-digit type price increases stepping into next year. And a lot of that will have to be borne by the consumer.
So that's a 2026 story. When you look at all of these automakers, who do you think is weathering the tariff headlines and the 25% levy on the auto sector the best?
Yeah, look, it's early days, right? I mean, we've heard about mitigation strategies. Like I said, GM's positioned itself well to make sure that even though it has a very large impact compared to its peers, they are positioned to offset at least 30% of it. In terms of exposure, obviously some companies have a lower footprint, outside the US. So those tend to benefit. They have less headwinds to combat. But overall, I would say, compared to Stellantis and Volvo, I've seen more progress being made at GM.
Nishit, going forward, do you see a scenario where many of these automakers based in America don't have a presence in Europe anymore?
Look, it is a possibility. A lot of automakers like GM have obviously done a lot of restructuring in that market and focused on just very specific marquee products that they export from here. So I wouldn't be surprised if a lot of other automakers take that stance where they minimize it to their absolute profitable brands, because obviously that's a very expensive area to operate in. So I would think that that's probably the playbook they'll apply. And it obviously depends on political cycles, right? Because product cycles outlast political cycles.
True. It's a good final point. Thank you, sir. Nishit Madlani there of S&P Global on the latest earnings from GM and a whole lot more. We know that the most competitive, one of, if not the most competitive market on the planet is the Chinese auto market, and the future there is clearly going to be dominated by Chinese players. For Europe, I wonder if the same thing's going to happen over in Europe with the Chinese dominating that market too going forward.
Which would be a disinflationary force, which is something that you've talked about, right? Is that what you're going to end up seeing that causes the ECB to cut rates more aggressively going forward? And we're going to hear from the ECB later this week. Let's hear if they say anything about Chinese products coming to the market.
Maybe causes these US auto players to back out of the market entirely.
That's what I'm actually wondering. If you have the 1-2 punch of trade tensions between the U.S. and Europe, and you have cheaper vehicles coming from China, how much does that start to really dominate a European market and transform it in ways that a lot of people aren't really thinking about right now?
Important final point. Products outlast politics, which is why many people on the other side of some of these trade negotiations are saying This is an individual who is done after this term, and potentially we can ride this out because maybe there'll be better trade deals on the table if Washington was to have a changing of the guard.
Once that money starts coming into Washington, that tariff revenue, we'll see if anyone wants to give that up.
They never end up coming out. That's what happens. Happened in 1939.
Saw that over the last few years with China as well.
That's true.
Up next on the programme, we'll catch up with Andrew Holdenhorst of Citi on his call for a rate cut in September.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
I'm David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening bow 60 minutes away. Equity futures just turning positive. We're positive here by 0.06%. With an update on your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Just wanted to give you another look at GM. We were just talking about the shares falling 2.5%, booking a $1.1 billion hit when it comes to costs related to tariffs. There's a lot of questions yet to be answered from GM as to whether this is the worst, what things look like from here. But we are selling first and asking questions later. 2.5% decline in the pre-market. Northern Trust, though, those shares are to the upside this morning by 2.7%. Semaphore reporting this morning that the Goldman Sachs CEO David Solomon had a conversation with Northern Trust not that long ago about possibly buying the bank, that they're looking to beef up their exposure to some low-cost ETFs. Those conversations could heat up, according to that reporting. Finally, some other earnings to go through. Philip Morris also reporting earnings this morning, shares falling 4.3%. That's despite the fact that they raised guidance really around their smokeless tobacco products, like those weird little Zyn pouches you put in your lip that are quite disgusting. But anyway, they fell because expectations were really high. They rallied 50% into these earnings reports, but missed on organic revenue. So investors really catching on to anything they can, and those shares falling. John.
Danny, thank you. Thank you very much for the latest on the stock market. Let's turn to the bond market. US 10-year yields falling. 4 straight days coming into Tuesday. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the programme. It's not a major rally, but it's a rally. We'll take it. Yields are lower. What's behind the move?
Yeah, I think there's some comfort here a little bit that that demand from foreigners isn't completely drying up, and we did hit 5% on the long end, and once we hit that, we did see some liability-driven investors take notice and start to buy a little bit in the long end. Like you said, it's not a massive rally, but at the same time, I think it shows that there's some stability in both the demand and the supply side, at least for now. And we're going into this week where next week we have the quarterly refunding announcement where Secretary Bessent is going to, for the first time, say, hey, here's how we're going to issue bonds. And right now it seems like maybe there's not going to be any new 10-year bonds being created above and beyond what's already expected.
So, Ira, with that question in mind, thinking out going forward from here, what's the incentive to push out more issuance along the curve?
Yeah, well, historically speaking, when you go back the last 40 years, interest rates are still relatively low. Not as low as they were, a decade ago, but compared to where they were in 2005 and 1995 and 1985, interest rates are still relatively low. I think that when it comes to how Treasury has to issue debt, it's really where do they think demand is going to be, and you want to issue bonds where and other debt where it's easily absorbable, number one. And number two, you have to think about how is the refinancing of that. So if you only issued T-bills, then you're refinancing that every three to 4 months. And you don't want to be beholden on, what's the market appetite in 3 or 4 months when you have the opportunity to buy, to issue 2s, 5s, 10s, and 30s. So I think that they will keep coupons stable this quarter. We had always expected them to be. But we actually just put out a note this morning that's available on the Bloomberg terminal suggesting that maybe now, because of this policy by the Trump administration, they won't increase the size of 5s, 10s, and everything else until next May, when they kind of have to. Otherwise, T-bills outstanding is just going to grow to a very massive amount.
Ira, just taking a step back, how global is the bond market right now, and how much are the yield moves that we're seeing in the U.S. affected by what's going on around the world as much as the domestic landscape?
Well, foreign investors are still a very important incremental buyer of treasuries all throughout the curve, particularly in the 2 to 5 year sector is usually where central banks and foreign reserve managers play. And then the long end is where pensions and other liability-driven investors tend to see strong demand. So we always talk about things like Taiwanese insurers, for example, wind up being large buyers of long-end treasuries. They're very important, but not as important as they were, say, 10, 12 years ago. 10 or 12 years ago, about 50% of U.S. treasuries were being purchased by foreigners. That's way less than a quarter today, right? So you wind up with things shifting more domestic in the U.S. as savings rates have gone up a little bit, as interest rates are a little bit more attractive. You have seen more domestic buying, and of course, the Federal Reserve, even though they're continuing to shed treasuries very slowly, they still own a lot of treasuries themselves. So they're a much larger. They're not an incremental buyer of the market and a price setter anymore like they were when they did QE, but they still own a fair share of the market.
Ira Jersey of Bloomberg Intelligence. Ira, thank you. If the Federal Reserve wanted us to stop talking about the Federal Reserve, this is how you do it. You host a conference on the integrated review of the capital framework for large banks. What a name they came up with over there, eh?
Sounds scintillating. I'm excited to hear about what they come up with on regulation.
Expecting Chairman Powell to take the stage any moment from now to address the integrated review of the capital framework for large banks.
What does that even mean? I mean, it's sort of vaguely, we're going to look at bank stuff and balance sheets and anything other than what everyone keeps talking about.
If there is some Q&A, and I don't know if there will be any, but if there is, this is still an opportunity to ask about the obvious.
Yeah. Will you step down? Do you plan to resign? He'll say no. They'll say, do you feel like this is compromising anything that you do at the Fed? The fact that every single day you get an ex post or a truth. And he's going to say no. And then people are going to struggle to ask the same question 15 more ways.
And they would do it all again next week at the news conference with Chairman Powell after the monetary policy decision. Here's the view on Wall Street this morning. Andrew Hollenhorst of Citi writing the Fed remains on course to resume rate cuts in September. Andrew joins us now for more. Andrew, good morning.
Good morning.
Why September, and what's leaning in that direction already?
Well, I think there's kind of a fundamental argument around September, which is the slowing that we've seen in core inflation. We still have tariff effects upcoming, but services especially look like they've slowed down. Labor market looks strong, but beneath the surface, there are some details that look a little bit concerning. You'd want to be moving towards neutral. That's a fundamental explanation. But then there's also just the Fed rhetoric explanation. They've set this up now. They've said we're going to watch the data over the summer. We're going to make a decision in September. In their dot plot, they've got 2 rate cuts this year, 50 basis points of rate cuts this year. That would also make sense with the September cut. So they've kind of set it up for September. You could argue it's going to be premature in September to know how big an effect from tariffs we're going to get or not in inflation. It's not clear that that's really the month when you're going to have all questions answered, but it looks like that's where they're headed.
On the labour market, in their last statement, the labour market conditions remain solid. Can they repeat that line this month?
I think they can still say that. There is a debate about how solid is solid. Some Fed officials have used the word solid. Other Fed officials have used the word fragile. So you kind of wonder, how can the labor market be solid and fragile at the same time? You look at the headline, we're getting 140,000 jobs per month. That's a strong reading. 4.1% unemployment rate. That also looks solid. But then you look beneath the surface and you see those 145,000 jobs. Well, really half of them were in the government sector, and there's probably some seasonal adjustment issue there. You look at that unemployment rate. Part of the reason it's low is because the participation rate has gone down, and that's because some workers are actually leaving the workforce because they're not finding jobs. That doesn't look as strong. So I think there is this kind of coexistence of a top-line number, a headline number that looks resilient, and the labor market overall has been resilient, but then these details that do cause you some concern.
We often say the stock market is not the economy. The stock market's not the economy. We see the stock market doing really well on the heels of earnings by companies that are doing really well. How do you counter companies doing very well with an overall backdrop that you see as weakening, as less favorable, just overall?
Yeah, so if we look at the economic data, you look at services spending. I think goods spending has been very volatile, so it's hard to read too much into that. Services spending, we've been slowing, and that's really been the engine of growth for the U.S. economy. You see that in Q1. I think we're going to see that again in Q2. And that's telling us that consumer demand is slowing down. We have a real mystery now if you kind of look at the data, because we know someone is bearing the costs of tariffs. It could be foreign exporters, it could be domestic firms, it could be consumers. We don't see consumer prices going up a lot yet. We don't see foreign exporters reducing their prices a lot, at least in the data. So then that would say that some domestic firms are absorbing some of these costs. That should be negative, maybe not reflected in what we're hearing so far.
So why do you think that we're not going to see any kind of inflationary pressure that would pressure the Fed maybe to remain on hold, despite some of the noise that we're hearing from Washington, D.C.?
So I think we will see some inflation. I don't think that that's going to end up constraining the Fed in a big way. And that's because the inflation that we're going to see is going to be in goods inflation. Now, if you looked at the June inflation report, you could kind of see it two ways. On the one hand, we didn't have a big inflationary effect. On the other hand, you had a few categories of goods, home furnishings in particular, where you're seeing some of those early tariff effects, and we'll probably see that in some other categories of goods. But the big question, and this is what Governor Waller has really emphasized, the big question is this going to be just restricted to goods inflation, or is this something that broadens? Are we getting broad-based pressure in services inflation, in wages that are going up, and just a general inflationary trend in the economy? There's no evidence that that's what's happening here.
Do we need to have the final rates to understand that story?
I don't think we can wait until we have the final rates. You would like to, right? And that kind of goes back to, is September the right month to be moving? if the objective was to wait until you had all questions answered, they're not all going to be answered in September. Maybe you'll have some clarity on the August 1st, but maybe not, right? Some of these negotiations may continue. And then even if new tariffs go into effect August 1st, we know where those rates are. How much do they pass through to consumers? What is the timeline on that? What's the extent of that tariff increase? We're not going to have all those questions answered.
Say it is just a 10% baseline overall, then maybe some different intricate deals for bigger partners. Do you think companies will be forced at all to pass on to consumers, or they're going to hold what they're doing right now, which is to eat a lot of it?
I mean, I think you'll see some of that passed on to consumers. Like I was saying, we're seeing some price increases already, but 10% tariff, that's pretty manageable. I think that's something that firms largely could internalize, and you probably don't see that much passing through into consumer prices.
How anchored are inflation expectations, both consumer-based and market-based?
Yeah, I mean, it depends a little bit on which measure you look at, and then you can really get into the issue of, are you just cherry picking the one that you like?
What do you think is more credible?
Well, University of Michigan is the one that's been all over the place, right? That one's much higher. Now it's come lower again. If you look at the New York Fed expectations, those have been more stable. I tend to look at the market expectations. There are issues with the market expectations, too. I'm not saying that there aren't. But at the end of the day, people are putting money on the line on those expectations. Those are expectations that, in some sense, are a stronger read on what people really think, what investors think about inflation. And those have not moved to levels that are concerning.
Right now, I'm looking right now at a market that has just defied all expectations when it comes to looking through all of these ramifications. What are you looking to hear from the Fed next week?
Well, I'm not sure that we're going to get a lot of new information from this Fed meeting. We know that we have a pretty big division across Fed officials. We have some that don't want to cut it all this year. We have others that think you should be cutting in July. That's one interesting element of this meeting. We could get a dissent from up to 2 governors. Governor Waller really sounded like he is planning to dissent at that meeting. We'll see if he goes through with that. That's really notable. We had a dissent from Bowman in 2024. Before that, you have to go back to 2005 before you had a governor dissenting on rate policy. So that would be kind of a signal that there's a pretty big division across Fed officials. I think what we'll hear from Powell is wait and see. We're waiting to look at the data over the summer. We're going to tell you in September.
But he's got to acknowledge the split on the committee, Andrew. I don't think he can get away with going into the news conference to attempt to reflect a consensus that doesn't exist. There's clearly a division. You see that in the SEP. You see that in the speeches from all the Fed officials. How tricky is that going to be in the news conference?
Yeah, I think this is very difficult, right? This is very, very difficult time for the chair when you have even your governors, right, that are maybe at odds over what the Fed should be doing. So I think what he does is he goes back to the data. That's what Fed officials typically do and say, that's why we're waiting, and that's why we're watching in July and August. And honestly, probably hoping to some extent from Chair Powell's perspective that they will get a clearer signal. It goes back to what we were discussing with the labor market, with the inflation data. You can read this data a little bit 2 ways, and that's part of why there's a division. Maybe we'll have some more clarity in the data by September.
Andrew, appreciate it. Good to see you. Andrew Honhorst there of Citi. Deutsche Bank's Matt Lazzetti said it a few times, came on the show and said it. This is not uncertainty. It's the vision of the Fed that the chairman needs to address.
And honestly, it's something that you would expect at a turning point in an economic cycle. You would expect people to interpret it differently. People on Wall Street interpret it differently. How does he do this while still remaining the position of chair who's setting the tone on a Federal Reserve that is increasingly fractured?
That news conference a week tomorrow. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. Coca-Cola reported second quarter sales growth that beat analyst estimates as consumers continue to pay higher prices for its soft drinks. And because of that, the company raised its full-year growth outlook. Coca-Cola also confirms what President Trump posted last week, that it will launch a new product made with cane sugar this fall. Meanwhile, the owner of the Los Angeles Times says he will take the paper public over the next year. In an interview on The Daily Show with Jon Stewart, billionaire Patrick Soon-Shiong said the move will allow the public to have ownership of the paper. If he goes ahead with an IPO, the LA Times would join the New York Times and News Corp among the largest publicly traded news organizations. And Citi is asking its first-year analysts to disclose whether they've already accepted a job offer from another company. According to a memo seen by Bloomberg, the change is intended to, quote, foster a fair and transparent environment. Goldman has made a similar move as banks look to clamp down on recruitment by private equity firms. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead. Look ahead through the rest of this week. Plus, the Space Foundation CEO, Heather Pringle, with a look at the booming space economy. That conversation just around the corner.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
The hierarchy of goals for the Fed is very clear. Stable prices and full employment above all else, financial stability. So this is all just a bunch of game playing. Once we get the jump in price level due to tariffs, does that transmit into second round inflation effects? And that's what the Fed has to call.
That was Adam Posen of the Peterson Institute. That is the Fed's call. Some people on the committee are ready to make the call. Governor Waller's one of them. Will he stick his hand up in just the next week and say, you know what, I'm ready to go. Let's cut rates.
Probably he will. That was sort of the indication. Will he have company, though? Mickey Bowman, as well as maybe some others as well.
And what will Chairman Powell's argument be? Not to do that. Find out next week. Big tease, huge promo. Federal Reserve decides a week tomorrow. Equity futures on the S&P 500 positive by not even 1/10%. The opening bell just around the corner, 30, 40, 41 minutes away. As we count you down to the opening bell, here's the trading diary. The week ahead looks like this. At 11:15, President Trump meeting with the President of the Philippines. On Wednesday, results from Tesla and Alphabet. Plus, President Trump delivering an address on AI. Thursday, a rate decision from the ECB and earnings from Intel and American Airlines. Plus another round of jobless claims. And one small data point into the weekend, durable goods. Elsewhere, let's talk about this. The Space Foundation out with its latest quarterly report showing global commercial revenue jumping 8% from a year ago to $613 billion. The leading driver, the private sector, which accounts for 78% of the space economy. Government budgets making up the smallest portion of just over $130 billion. Potential catalysts for growth include President Trump's Golden Dome, Elon Musk's Starlink, and commercial spaceflight. Joining us now to discuss is Heather Pringle, the CEO of the Space Foundation. Heather, welcome to the programme. Lots to work through here, but the numbers that jump out to me are the 78% coming from private enterprise. Do you see the private sector doing much of the heavy lifting of the space economy for the years forward and the foreseeable future?
Absolutely. The commercial sector is right now valued at $480 billion for 2024, and that is an 8% growth over the prior year. And when we look at the 12 sectors that constitute the commercial market, we look at position, navigation, and timing, which comprises $231 billion. The number 2 service just behind that is ground infrastructure and equipment, coming in at $123 billion. Both of these subsectors showed a 10% growth over the prior year. So with something like position, navigation, and timing, this is coming into every swipe, tap, and left turn that you make using those global navigation satellite services.
Heather, I'm struck by the fact that, yes, the private sector is the one that's leading the charge into space exploration and space use and the space economy. And yet there's a huge national security component to this, with the likes of China and Russia trying to exploit this whole network, possibly disrupting the United States. Based on your research with the Air Force, your service with the military, I'm just wondering how prepared the United States is for that in terms of government coordination with the private sector.
Well, absolutely, the United States is the #1 investor in the global space economy, and this includes all sectors: commercial, civil government, as well as national security. Now, you were pointing out what the United States is doing on the national security side. $49 billion of investment into our national security enterprise. Over 90% of that is going to the newest service, that is the United States Space Force. This is well ahead of what we see. China is investing, for example, on the civil government side. The United States is investing $27 billion in the civil government space economy. China's investing 17%, so we're well ahead on that. You can also look at the launch record. For example, the first 6 months of 2025, the United States is launching at a record 97 already. Launches these first 6 months. China is only a fraction of that, well under 20. So the United States is leading, it's leaning forward, and it's doing a lot to prepare for this. You mentioned Golden Dome as well. This is a huge initiative valued at $175 billion for the entire development effort. It's going to have a large commercial component. They're looking at short timelines. They want capability, whether it's everything from sensing to tracking to intercepting, and the commercial space market is really ready to deliver.
Well, the Golden Dome just locked in $13 billion. They named someone to be a project leader. But this morning, Reuters is reporting that Trump is looking for alternatives to Musk's SpaceX to lead that project. What companies in the private sector could lead that project in your view?
Well, Golden Dome is going to be a national security project led by the recently confirmed 4-star General Mike Gutlein. He'll be here with us today at our program. But to your point about who are the commercial entities who can step up to the plate, there are a number of companies that are leaning forward, delivering capability. This is a multi-layered capability when you look at the totality of what Golden Dome is. It's launch, it's sensing, it's tracking, it's intercepting. And so even if you did take a deeper look at the launch enterprise, there are over 14 companies around the world who can deliver that, 10 different nations. So it's a whole of nation effort, and there are a lot of companies who are able and willing to step up to the plate.
I guess what you're saying is if it's not going to be SpaceX, there will be a company that can fill that role. Do you have a timeline of how long this project can take?
Well, I would say there have to be a number of companies, whether it's SpaceX or others, who need to contribute to this project. The scope of it is so large that it really is going to take a number of companies delivering these different capabilities. As far as the timeline, we are looking at, the president has announced that it should be on a 3-year timeline. So that's looking for capabilities that are out there, that are fairly mature, that are tried and true and existing. So that's what it'll depend on.
These numbers are getting bigger and bigger. Looking forward to tracking this story with you once again. The Space Foundation CEO, Heather Pringle, there on the size of the space economy.
I love the space economy discussions. I've got to say, I love the idea of what can happen there, whether we're all entering sort of the Obi-Wan Kenobi, Yoda world. I mean, honestly, all of the science fiction coming to reality, and how that is a serious threat when it comes to international warfare.
I prefer it when you talk about the bond market.
Yeah, this is too existential.
Right?
Maybe that's her next broadcast.
I grew up with a family that watched science fiction. I know that's going to be a shocker to a lot of people.
I'm surprised at that.
Really?
I'm surprised.
I didn't actually watch it, but my father.
You didn't watch TV?
Well, yeah. He had a black and white one that he pulled out from underneath the
And
piano.
you were allowed to watch some science fiction.
Saturday nights it was Doctor Who.
There we go. Get the camera back to me. Brahma does not want it on her. Okay, tomorrow, Julian Emmanuel of Evercore. We'll also catch up with Ella Hodger of Newton Investment, Ben Keller of Baird, Republican Senator Bill Hagerty of Tennessee. From New York, this was Bloomberg Surveillance.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look at what's happened is because the interpretations of AML, anti-money laundering, BSA, Bank Secrecy Act, KYC, know your customer, know your customer's customer. You know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis, and we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity, ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Equity futures taking a breather after hitting a fresh record 30 minutes ago until the official start of trading. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, earnings season picks up with reports from Tesla and Alphabet on the horizon. Meanwhile, you have Treasury Secretary Scott Bessent offering support for Jerome Powell, saying that he sees no reason for the Fed chair to step down now, and railroads could be taking another crack at M&A. Details on those deal talks ahead. Shonali, what do we have under the surface here?
Earnings season. We're looking at some of the defense companies. Lockheed Martin down almost 7% pre-market. And of course, you're looking at them missing expectations as well as reporting a pretty significant loss here tied to results. Katie, I think you're also looking at General Motors.
Yeah, let's talk about General Motors. This was a really interesting one. Of course, you had GM come out and say that they expect an even bigger hit than was expected from tariffs to the tune of about $1.1 billion. They actually beat on several measures when it came to this earnings report, but you can see shares down 1.7%.
We're going to now bring in Bloomberg stocks reporter Nora Melinda. More on defense earnings this morning because unlike Lockheed Martin, you're seeing Northrop Grumman rising. And perhaps explain here, Nora, the tale of two cities we're looking at.
We're definitely seeing a tale of two cities, as you're mentioning today. We're seeing shares of RTX. Now, this is one of the biggest U.S. defense contractors that we track, Lockheed Martin being the second biggest here. And we have Northrop Grumman. We are seeing that in the green. And this is, of course, is after we got results today that it boosted its full-year adjusted EPS forecast. But we are seeing shares of RTX and LMT both lagging this morning. And that's after they had earnings that missed expectations. But coming into this earnings season, we were seeing a lot of the street a little bit pessimistic, if I will say. They were expecting that this would be the reaction, that either we would see shares trade flat or we would actually see them trade off, because of course a lot of people are thinking about the defense space and as we're thinking about the budget in regards to the Department of Defense and a lot of these other headwinds that we've been seeing the sector dealing with when it comes to supply chains and all these other aspects here. So not a surprise with what we're seeing in terms of the share move in this pre-market trading, but definitely interesting when you're seeing Northrop Grumman breaking out here.
It's also unintuitive to the casual follower of defense names. You would think that these are the sort of companies that would be in the spotlight that might be benefiting from the currently fraught geopolitical environment we're in. You think about what's happening with European defense companies. They've been absolutely skyrocketing. It's a more nuanced story when it comes to American defense.
Absolutely. I mean, we did see, of course, all these geopolitical tensions that you would anticipate being a tailwind for defense, but we do have the street. I mean, we can't say that these companies are really doing poorly this year. We are talking about stocks that still remain in the green. But if you look at the broader defense and aerospace industry more broadly, we are seeing a bifurcation here. You're seeing aerospace stocks really driving the rally in that sector, and you're seeing these U.S. defense contractors lagging behind here.
All right, Nora Melinda, great reporting as always. Keeping an eye on Lockheed Martin and the like. And staying on earnings, Dutch semiconductor designer NXP gave a weak forecast over concern that auto sector disruptions will hurt revenue. We're also looking ahead to Google earnings tomorrow as Google notches up a really impressive win streak. Let's bring in Bloomberg Tech co-host Caroline Hyde with all the details right now. And I guess we start with the bad news. NXP Semiconductors really taking a hit this morning.
It is, and it's because they didn't quite live up to the highest of expectations. And I'm afraid in this current environment, if you're not going to be meeting the street expectations, even the whisper numbers that are at the top end, you're going to see your stock fall back down. This is a company that has been in the eye of the storm when it comes to tariffs. We've seen what Renault's numbers were like, what Stellantis' numbers were like just yesterday. And when you've got that sort of tariff exposure, then the chips that are going into the future of EVs, for example, is going to be curtailed. Therefore, future demand is not living up to the hopes. NXP already was seeing revenue on the decline, but it was sharper than expected in the fiscal second quarter. And the forecast really is where the expectation is being a little bit underwhelming. So we're seeing revenue deplete quarter on quarter. And all of this at the moment is as we start to see also not just the auto sector be under the pressure, but also just automation of manufacturing, the thing that we keep talking about bringing to the United States. Well, globally, it's been impacted by tariffs too.
Really mixed bag when we look at how tech earnings have been coming out so far in tech-impacted sectors. But I want to talk about Google, Alphabet. Yeah. You are looking at them on a 9-day winning streak, on track for their longest winning streak since December of 2010. Yeah. So a lot of excitement heading into those results tomorrow. How are investors kind of stacking up how they'll do?
I think they're looking at the valuation, Shanali, because actually compared to the S&P 500 or compared to the NASDAQ 100, the valuation of where Google trades versus its future earnings is much less than rivals. What has been the cloud for Google and Alphabet, the parent company, is of course antitrust. The worry that they won't be able to be garnering as much money from Apple in the future because, of course, the fact that you're going to automatically be putting maps on an Apple phone, for example. All of this just means that we're worrying about the monopoly of the future and the way in which that they're being impacted as well for the future of generative AI. Many have questioned whether the business model even needs to be split in two and whether you sell off the various parts. The fact that very few analysts have said that, but the fact they've said it at all, has all been this overarching cloud among valuations. So I think people are thinking, okay, look, numbers could look relatively possible. We've got Bloomberg intelligence analysts saying, look, we like the strength of the advertising sector for them. We like the way that AI overviews has been benefiting them, and they've been intertwining generative AI into the search product. And thus far, you and I might have ChatGPT on our phone, but it hasn't stopped us using Google. And I think until that starts to bear out in the numbers, we like the fact that they're still owning that space, and indeed Waymo as well, doing nicely for the other bets revenue stream too.
Yeah, I believe that segment is expected to see about an 18% jump when it comes to revenue. Looking forward to actually being able to parse through those numbers tomorrow. Speaking of Waymo, speaking of reporting after the bell tomorrow, Tesla coming up and taking the stage as well. You take a look at the GM figures this morning, really taking a hit from tariffs. Tesla has really positioned itself as, you know, the most immune from some of the tariff impacts that are hitting the automakers.
It is, but then it's deeply exposed to what is a pullback in regulatory support for the future of, well, solar, of future of better batteries, the future of EVs. What's interesting for Tesla is in the next couple of quarters, maybe you'll see a pull forward of the EV credit that's going to be wiped out, $7,500. Well, that's only going to suit you until the end of September. So buy your Teslas now. So maybe we'll see a slight support to what has ultimately been a dire state for sales in the US, Europe, and beyond for Tesla. Remember, we got the delivery numbers for their fiscal second quarter. They were ugly. They were down 13%. But as you say, they do make the cars largely either over in China or in the United States. So from a tariff perspective, maybe they're not exposed, but I think more from a sentiment from the administration, a change on support from also getting credits. Remember, they get an awful lot of money because other car companies can't live up to what had been previously enforced environmental targets. And so they bought regulatory credits from Tesla. They're not going to be buying them anymore.
Caroline, we're looking forward to your coverage. Of course, the earnings season kicking off hot and heavy. Bloomberg Technologies, Caroline Hyde. Now back to General Motors. Earnings beat estimates, with the automaker says that U.S. tariffs added more than $1 billion in costs for the second quarter. Let's bring in Bloomberg's Detroit bureau chief, David Welch. What did you make of the numbers themselves, David, and the outlook that they had given?
They affirmed their outlook for the year, which was already, based on the hit they were going to take from tariffs. Look, I think this quarter was one that really shows the full impact of tariffs on the auto business, because the mitigation efforts GM is taking, resourcing some parts from companies inside the U.S., cutting costs internally. They've moved some production already by slowing assembly lines in Mexico and Canada for pickup trucks and then speeding up the lines at a big plant in Indiana. But these are all things that kind of nip around the edges of it. There's really no way for GM to get back to pre-tariff profitability, and I think that's why the shares are down. And on the call with analysts, CFO Paul Jacobson made a couple mentions to the company's profitability if you backed out that tariff impact. So what he's saying is, hey, the business is still solid and strong, but in this new trade environment, we're just not as profitable as we used to be. And that's what investors are looking at. How does this company and other auto companies, how do they raise profitability when they've got this huge headwind, this huge tariff bill to wrestle with going forward?
Well, David, my understanding is that you take a look at pricing, and that's a lever that GM hasn't pulled to this point. You take a look at their average sticker cost, and it really hasn't risen at all. When you think about tariff mitigation efforts that GM could take in this environment, what about just raising the price of their cars?
Yeah, look, everyone's been saying that for the last, 9 months, ever since Trump started rattling the saber about tariffs. And, look, you can't view that in a vacuum. GM could go out and say they're going to raise the price of everything they make by $10,000 and consumers just won't buy them. And these are consumers who are already beset by very high interest rates and pretty close to record vehicle prices as it is. Some companies have sneaked in very small price increases, but consumers are kind of tapped out. That's why we're selling on a pace for 16 million vehicles, whereas a few years ago we used to be 17 million vehicles a year plus. Consumers just aren't biting on it. They'll keep their cars longer and repair them. They'll try to go to the used market. Anything to avoid what is now an average monthly payment of well over $700, with a record number of people paying over $1,000 a month. And when people are tapped out, the tariffs kind of go into your profitability because you can't pass the cost on.
David, we're so grateful for your time. That is David Welch of Bloomberg News. And of course, don't miss it. Later this hour, we're going to speak to General Motors Chief Financial Officer Paul Jacobson. We will talk to him about any potential for price increases, if you can get them, those tariff strategies. Let's see what else they've got going on. Some movers also on our radar. Coca-Cola sales beat estimates. Cane sugar is coming this fall. You still see them down. Speaking of expectations relative to reality, Katie.
Yeah, this is to appease President Trump. This will be U.S. cane sugar. I haven't really been following this controversy, but definitely caught some eyeballs this morning, not really making a difference in the stock price. But how about Philip Morris? It actually raised its guidance on strong sales of Zyn. We know that has been very, very popular, got a boost from the FDA recently as well, but the stock down about 6% right now, Shonali.
Yeah, organic sales trailed estimates, even as Zyn remains that trading floor favorite, Katie. I'm also watching CSX. You pointed this out this morning as well. Last night, it made a lot of headlines that report that BNSF is exploring a takeover of a rival. Of course, CSX is considered to be potentially in that crossfire. Let's see how it goes. Railroad consolidation. I know we're going to talk about that more later in the hour.
Yeah, the sell side definitely catching that attention there. TD Cowen raising its price target and upgrading CSX basically on the idea that it could be a consolidation target. We'll talk more about that, as Shonali said. But coming up, Treasury Secretary Scott Bessent calling for a review of the Fed's headquarters, but says that he sees no reason for Jerome Powell to step down right now. That conversation up next. This is Open Interest.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Welcome back to the circuit. This time, we're taking you to the frontier.
Where is
do we
the
have
camera?
a camera, or do we? We don't want to lose you, Emily, in all of this.
Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure build in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
And now to high interest, a look at what's making headlines around the world. OpenAI and Oracle announcing a partnership to develop additional U.S. data center capacity to power AI workloads. OpenAI has not yet said where the sites will be located, but states including Texas, Michigan, Wisconsin, Wyoming are all under consideration. And Open Door Technologies is extending its gravity-defying rally from last week. Investors pile into the stock and found a sudden fandom among retail traders and social media platforms. Take a look, another 20% higher. Pre-market, analysts are comparing the moves to what we saw in the GameStop era in 2021, which you might remember very well. And paint maker Sherwin-Williams missing earnings estimates and cutting its profit forecast thanks to soft demand for paint products. The CEO expects softness to get worse in the second half of the year. Pretty interesting setup, Katie, as earnings season continues to forge on.
Absolutely. Watching companies try to navigate the geopolitical landscape and what trade policy is at this day is definitely something that we'll continue to watch. But let's head to D.C. right now because the Federal Reserve is hosting a conference day in Washington, providing updates on key regulatory capital framework. Fed Chair, geez Louise, Jerome Powell kicked off that conference.
We need to ensure that all the different pieces of the capital framework work together effectively. Doing so will help maintain a safe, sound, and efficient banking system for the benefit of the people we serve.
And for more, we're joined now by Stuart Paul of Bloomberg Economics. And Stuart, let's pull back the cover. Everyone just wants to know about what's going on between the president, the administration, and Jerome Powell. You had Scott Bessent on the wire this morning saying that he doesn't see a case for the Fed chair to step down at this moment, but I mean, we know which way the wind is blowing when it comes to the whims of this administration.
That's right. The administration very clearly wants lower interest rate policy. The administration very clearly wants the Federal Reserve to cut interest rates by 200 to 300 basis points. That's what we heard from the Fed chairman. And they're using other functions of the Federal Reserve, including its banking authorities, including other sort of like supervision requirements that it's imposed on the banks that it supervises, and including the renovations to the Federal Reserve's headquarters as some sort of red herring or cover to muscle or apply political pressure to the Fed to lower interest rates. But that's an ever-evolving set of circumstances. As you said, just this morning, Scott Bessent was taking a step back and saying monetary policy, the monetary policy and interest rate setting function of the Federal Reserve should be sort of set aside in a jewel box. And I think that that's right. If you want to take shots at the Fed for spending too much on its renovations, fine, but that interest rate setting authority of the Fed should be set aside.
So speaking of the jewel box, Katie, you pointed it out this morning. I think it struck a lot of people to hear Mohamed El-Erian, of all people, say that if the Chair Powell's objective is to safeguard the Fed's operational autonomy, which he deems vital, he says, then he should resign. And I think it raises the question here, surprising to hear this from him. He says it's not the consensus view, but does this show that the pressure being put on the Fed chair is already impacting the market? It's already impacting what the independence of the Fed is perceived as by the market.
It is a little bit, and we saw last week when news reports hit the wire that the president was planning on firing Fed Chair Jerome Powell. Long-term bonds sold off pretty dramatically. When the president then pulled back during a meeting with, I guess, the Bahraini prime minister, that no, in fact, he was not planning on firing the Fed chairman, we saw prices rebound for those long-term bonds. Now, so clearly, Dr. El-Erian is correct that the market is questioning the extent to which the Fed can stand pat and stay politically independent of the administration. But as he goes on to say in that quote, the first best situation is not for the Fed chairman to resign. The first best situation is for rhetoric to sort of be toned down in the White House. And I think that we can see some of that. We are seeing some of that from Treasury Secretary Scott Bessent.
And it's interesting, you know, it feels like this is really heating up as we really barrel into a Fed meeting next Wednesday. Jerome Powell, even on the best days, I feel like he doesn't look forward to the press conference, but next Wednesday, I feel like he especially won't be excited for some of the questions he's going to be taking.
No, he's undoubtedly going to be sent the question, how much are you taking political considerations into account when you're setting interest rate policy? I think that the only real question to ask him about political considerations is, do you feel more compelled to stand pat and hold interest rates steady in the face of political pressure? When he then says, no, we're actually just focused on serving the American people, you then have to go and the next question as a follow-up should be, well, the bond market just last week and into this week has been questioning your independence, has been questioning your resilience to that political pressure. what can you do to regain the bond market's confidence that you are in full control of monetary policy?
That's the big question. We'll see if he gets that one next Wednesday at about 2:30 p.m. Stuart Paul, Bloomberg Economics, great to speak with you. Let's take a look at these equity markets just about 10 minutes away from the opening bell. You can see, again, taking a bit of a breather when it comes to the S&P 500. I'm going to go ahead and call that unchanged, but we know we managed to close in the green at a record yesterday, so can't complain too much. Then you take a look at the NASDAQ 100. Down slightly, but pretty much unchanged. Same story, too, if you take a look at the small cap, Sonali.
Can you believe that Matt Miller is not here to see 6,300?
I know. Somewhere, Matt Miller is celebrating.
Anyway, some more movers on our radar. A lot going on under the hood. Coal stocks today, they are climbing on potential production cuts at Chinese producers following government mandates to limit overproduction. Katie, have you been learning more about coal and copper?
Coal and copper? As I learned yesterday, smelting. It's a whole thing. You can produce the copper in the U.S. and you got to send it out. I look forward to continuing my knowledge there. But coming up, analysts saying that Sarepta has zero value following the drug makers' fight with U.S. regulators. We're going to bring you the details on that skirmish next. This is Open Interest.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Ottawa, Canada, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Well, we're monitoring Sarepta shares continuing to drop in the pre-market, falling 35% on Friday alone after its fight with the FDA developed. The FDA, or Sarepta rather, refusing to pull its lead therapy and then finally announcing a voluntary pause of the drug. Let's talk about this with Bloomberg Health reporter Bob Langreth. And Bob, you were telling us in the commercial break that controversy has been following Sarepta for a while, but get us up to speed on what's currently happening with this company and the FDA.
Yeah, so Sarepta's drugs have been controversial for a while over like the level of data backing the efficacy of the drugs and whether the drugs truly slow the disease or not, because the trials have either not been completed or in the case of this gene therapy, produce kind of mixed results at best. But now the latest controversy is over the safety of the drug, and there have been 2 deaths in people on this gene therapy drug linked to liver failure. And then there's a 3rd death that just emerged last week on a related gene therapy from Sarepta, also from liver failure. And then that developed this huge fight. This is unprecedented fight between the FDA and Sarepta over whether Sarepta should stop shipping completely stop shipping the drug while the FDA investigated the deaths and the safety. And Sarepta on Friday initially, refused the FDA's request to stop its shipments. And then late last night, it reversed course and capitulated and agreed to stop shipping the drug, which is its main drug. It's its biggest drug, this gene therapy drug, until the FDA finishes its investigation. So now it's not shipping, its biggest product. The future, its future, it's just not clear what's going to happen to the company right now. And it has a big debt load. Some of it's due pretty soon. And yeah, everything's up in the air.
Yeah, well, when it comes to the future, you have H.C. Wainwright coming out and said that this company is worth 0. That is officially their price target. Bob Langreth, I know you're a busy man following this company. We appreciate your time. Now, less than 4 minutes until the opening bell. We're going to walk you through all the opening action up next with Doug Sioka of Kavar Capital. That conversation up next. This is Open Interest.
And Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis, and we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity, ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
We are moments away from the official start of trading on this Tuesday morning. Welcome back to Bloomberg Open Interest. I'm Katie Greifeld. You take a look at the setup as we head towards that opening bell. You can see a market really looking for direction, maybe dealing with a little bit of buyer's fatigue. Of course, we know we have a whole bunch of risks staring us in the face, really getting into the heart of earnings season, just 8 days away from that Fed meeting next Wednesday. And for right now, it seems like traders are content to let the S&P 500 hover, and I stress hover, at these all-time highs. You can see that the bells are ringing over at the NASDAQ, down at the New York Stock Exchange as we officially get underway on this Tuesday. Hopefully, there's a little bit more action underneath the surface here.
There sure is, and traders are discerning this morning on earnings season. You have Lockheed Martin that was already down on the year. They cut its forecast after reporting a $1.6 billion loss on its aeronautics and helicopter businesses due to special charges. The stock down almost 9% at the open after more than 5% this year, Katie.
And we're also keeping an eye on General Motors actually beating estimates, but the automakers said that U.S. tariffs added more than $1 billion in costs for the second quarter. We'll be speaking with the CFO in just over 10 minutes time. But I also want to talk a little bit about Kohl's here because shares are absolutely surging, up 85%. That move would be the biggest on record if that holds through the close. Still looking for a reason here. We will keep you updated. One potential, though, could be the fact that you have short interest clocking in at 48% of its float. So maybe a little bit of a short squeeze underway. We'll continue to monitor whatever is going on with Kohl's, but let's broaden out here because you have fund giants, including Invesco, Fidelity, and JP Morgan, really leaning into risky bets despite global trade tensions. Those firms are justifying that risk exposure with a Trump put, betting that President Trump's threats to disrupt the economic order will fall short of a complete collapse. That could suggest that sitting out of this market volatility is the riskiest position of all. Caval Capital Partners CEO Doug Sioka joins us now on that point. And Doug, it's interesting. At the same time that you have $7 trillion in money markets and growing, you also have the S&P 500 just going up and to the right. How are you making sense of the different cross currents at this point?
Yeah, thanks for having me on this morning. I think the market is in what we're calling kind of a greed with caution phase. I mean, there's certainly plenty of tailwinds, right? Earnings per share growth, it's early, right? But 83% of companies that are reporting right now are beating, so that's encouraging. So a very strong labor market, so that's fueling the consumer base of our economy that we rely on for propulsion. I mean, we do have modest improvement in like U.S. geopolitical standing, believe it or not, right? Despite some of the ongoing negative headlines. We've got currency weakness that helps multinational companies. And like I said, consumer resiliency. And keep in mind, Katie, that still 48% of the Russell 3000 are trading 20% below their 52-week highs. So if you broaden out, there's still some opportunity in investing in stocks for sure.
What an optimistic point of view on this. I think that this is exactly where I was going to go next, because if you look at the S&P equal weight versus the S&P 500, there is a divergence, and you're actually seeing, I'm stealing this from Kevin Gordon over at Schwab, another fresh 22-year low for that equal weight relative to the cap-weighted S&P 500. And it just shows you how much love there has been for the really big guys. I'm wondering how you feel about the catch-up trade. Who can be a part of it through the rest of the year when you still have tariffs weighing on some earnings?
Yeah, if you think about it, Sonali, right, you have four sectors that are really leading the U.S. market. And interestingly, I think everyone would be like, oh, technology. Well, technology's third behind industrials and utilities. You have two sectors of the S&P that are actually negative year to date, right? You've got consumer discretionary and healthcare. Healthcare down by almost 3.5% year to date, so underperforming by 1,000 basis points of the S&P. And certainly, right, investors over-extrapolated probably the enduring positive impacts of COVID. I think they are now over-extrapolating the negative impacts of RFK's policies. And undeniably, right, mean reversion is very strong, but people probably overestimate how quickly it's going to happen on both the way up and the way down. So I think if you're just taking opportunities, the dollar cost average and the names that have been underperforming, but that have really strong balance sheets, great total addressable markets, and really strong sight lines on future cash flow with a multinational bent, there's still a lot of places to put money to work in the equity market. And that doesn't even mention the fixed income universe, which we think is still very attractive.
Well, just to your point on healthcare, don't forget we have the looming threat of pharma tariffs as well that this market is trying to make sense of. So we'll continue continue to watch that one. Healthcare, your worst performer year to date on the sector level. But let's talk a little bit about fixed income. I actually had a great conversation with the deputy CIO of DoubleLine Capital yesterday, Jeffrey Sherman, who said that he's positioning here for lower rates, that there could be a shadow Fed chair dynamic going on. We know that probably against Jerome Powell's wishes, the conversation around the Fed has become very, very political. How do you approach that, rather, from an investment standpoint?
Yeah, so if you think about it, right, what's most important about the bond market, right, is strong balance sheets. And corporations as well as municipalities have very strong balance sheets. They took opportunities, unlike the federal government, to refinance their debt when rates were at historic low levels. So you have really strong balance sheets. You also have tight spreads. So in our opinion, it doesn't make any sense to try to deviate from high quality. It's just not enough yield pickup to do so. You can put in place almost like a barbell strategy, because the middle of the curve, even though we've seen steepening, the middle of the curve is still offering some opportunities. If you can lock in 15, 20-year maturities at 2.5% to 3.5% of positive real yields, and then sort of spend a little bit more time at the front of the curve so you can be a little bit more flexible in reacting to Fed policy, we think that makes a lot of sense. But when you think about bond investing right now, be prepared for the perverse, right? The Fed cut rates 3 times, 100 basis points last year, and what happened? The yield curve steepened, came out of an extended inverted state.
Yeah.
That was way counter to what people's expectations have been.
I want to double down just on that point, because even if you get those rate cuts, there is a lot of doubt in this market that you can see it bringing down the long end of the curve. It was certainly what the Treasury Secretary would want. However, you have the market consistently betting on steepeners, particularly when the president has put so much pressure on the Federal Reserve. Deutsche Bank is looking at 30-year, so they're looking at the 5 to 30-year spread here. How much risk is there at the long end, and how much risk does that provide to the equity market as well if long end rates stay high?
Yeah, it becomes a headwind, but it comes back, Sonali, to supply and demand, right? If Bessent and the Treasury Department is talking about refinancing debt at lower levels, therefore the bludgeoning in public of Powell's unwillingness right now to cut considerably. If that happens, they buy more debt at the short end, you're going to see prices go up and yields down. They're neglecting the longer end, right? So you see prices go down and yields go up. So we do think there will continue to be some spread widening, but they're also actuarially, when you get to, let's say, 5.5% 30-year, God forbid it's to 6%, which is actually joking as relates to God forbid, because that could be a great opportunity. You have a lot of large institutions, pension, actuarial, hedge funds that will lock in those spreads, not to mention some of the carry trade capability that may arise. So we think there'll be enough demand when you get to that significant barrier, 5 to 6%. So that would probably stabilize that area, but supply and demand would indicate the curve's going to steepen if the Fed cuts.
All right, we'll have to check back in with you on that once we finally start to get some of those Fed cuts. Doug, great to see you. That is Doug Sioka of Kavara Capital Partners. Meanwhile, let's get a check on the stock market right now. I am so excited to talk about this move screen, because take a look at that breadth. It's actually really good right now. You have nearly 400 companies in the green posting gains this morning, just 100 or so in the red. But you have the index pretty much unchanged, maybe a touch higher, because take a look at the downside. Up at the top, NVIDIA down 1.4%. That is your biggest points contributor to the downside right now. That is weighing down this index, really keeping the S&P 500 constrained, even though you have all these names fighting to go green. It's a similar look at the sector level as well. Positive breath, really strong signal there, but still, when you take a look at what is losing today, it's the important names. It's tech down about 0.4%. Consumer staples also taking a hit. We were just talking about healthcare with Doug Sioka. You can see that healthcare, it's the worst performer year to date, but it's the best performer on this day, up 1.3%. That might seem unintuitive given our conversation around Sarepta, what's going on with that health stock, but Sarepta isn't in the S&P 500, and as such, you can see healthcare is your winner, at least for this moment, Sonali.
And coming up next, we're going to talk about another sector, autos. GM shares are falling, actually the most since April intraday, as President Trump's tariffs hit the company's earnings. We're going to be joined by General Motors Chief Financial Officer Paul Jacobson joining us next. This is Bloomberg Open Interest.
case you missed it on Bloomberg Insight.
Losing a few people is not actually that unusual. These companies are constantly pulling people, in both directions. The real question is, can it turn around Meta's fortunes? It's about who is leading in terms of adoption, in terms of B2B use cases, B2C use cases in different countries. And we're seeing Chinese companies certainly making a strong showing across many of those fields, even if, I would say that the US is still generally in the lead. But what we've seen at the company level and at the product level is actually that continued decoupling. So I think it's a pretty safe bet that is going to continue to be the case.
Not to bring up the past, but you've criticized Sam Altman. I'm just wondering whether you've made peace with Altman on the back of that drama.
So we haven't actually interacted since the time. I'm sure at some point soon we'll end up at the same event, and the AI world is pretty small, but no, haven't had a chance yet so far.
Don't miss Bloomberg Insight live weekdays.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
All right, okay, ready?
David, what initially sparked your interest in this topic of longevity?
15 years ago, I turned 60, and I began to wonder how much longer I'm likely to live and what I could do to extend my life. On longevity, I talk with the leading experts in science and medicine to educate people about how they might be able to change their conduct so that they can live a happier and healthier life. I'm David Rubenstein. Join me on a 4-part journey as I explore the great quest for longevity. Only on Bloomberg.
Welcome back to Open Interest. It's time now for our top calls. Some of the analyst action in focus this morning. And first up, Lululemon is getting downgraded over at JP Morgan. The analyst cites a more cautious and discerning consumer and sees growth constraints in the Americas region. Shares up very slightly this morning. Next up, we have Shopify getting cut over at Loop Capital on valuation concerns. Now, the analyst says that they would wait for a more attractive entry point. Maybe they're getting it today. Shares down 2.3%. And finally, TD Cowen is adding Norwegian Cruise Lines to its top picks ahead of its earnings next week. The analyst is also initiating coverage on Carnival and Royal Caribbean with buy ratings, saying that cruise lines in general are underappreciated. Now, one stock that we're keeping a close eye on this morning is GM. Shares are lower after the company said it will take a $1.1 billion hit to profit from President Trump's tariffs. Let's bring in General Motors Chief Financial Officer Paul Jacobson for more. Paul, it's great to have you with us. I want to talk about potential levers that you can pull here, because my understanding is that you really haven't raised prices to this point to offset some of those costs. I know that you're taking other measures, but is it possible that you could raise the sticker price on some of your vehicles to make up some of that hole?
Well, good morning, and thanks for having me today. It's a beautiful day here in Michigan, and we're celebrating another good quarter. And I think obviously tariffs have had some pressures. We've adjusted to them, but as we just said on our earnings call, we're 90 days into this, and our plans are still very consistent with what we said at the beginning, and we're going to continue to execute on that. We've got a strategy here that is both short-term and long-term. In the shorter term, we've talked about our ability to offset 30% of the tariff impact. That's through some cost austerity as well as some manufacturing changes and pricing. But we think that as we maintain our consistent pricing strategy where, we look at the demand for our vehicles and where that sits and our disciplined inventory approach, that we can continue to absorb that and reflect that in our traditional and sort of consistent pricing actions rather than going out and announcing big tariff-related increases, because we don't think that's necessarily good for the consumer as well. So pricing is a part of it, but nothing out of the ordinary or extraordinary from what our current strategy has been.
How much flexibility, Paul, do you have to make adjustments to supply chains here to meet the evolving auto tariffs and the parts that tariffs might hit in parts of the supply chain?
Well, there have been things that we've already been working on. So really, kind of since COVID, we've been looking at creating more resiliency in the supply chain, and we've onshored a lot of things, as we mentioned in our last call. Only about 3% of our direct purchases come from China through the supply chain. So that's helped us a little bit in terms of being proactive on that. Obviously, we'll do some resetting in partnership with our supply chain partners, but it really starts with our manufacturing footprint. Earlier in the quarter, we announced $4 billion of investments over the next couple of years to increase production in the United States. And when we're done with that, which will start in about 18 months, we'll be producing more than 2 million vehicles here in the U.S. So comfortably putting us in a position where we produce more vehicles here in the country than anybody else. So we're working on those and also partnering with the supply chain across the board. So while we have a pretty sizable tariff impact this quarter, as we've talked about, it's not a surprise against what we told the street at the beginning of it, and our plans are executing well according to our playbook.
Let's talk about how those plans play out over the course of 2025, because GM has said that you can offset 1/3 of that $4 billion to $5 billion in tariff exposure later this year as more of your mitigation efforts really start to take hold. Can you give us a timeline there? When might we see some of those efforts actually start to bear fruit in terms of offsetting some of these costs that you're dealing with?
We'll really begin to see that in the third quarter and the fourth quarter, as we've told investors. Some of it is pricing, and our pricing was up in the first quarter. It was about flat here in the second quarter, but we've expected pricing to be up about 0.5% to 1% for the full year in 2025. So as model year 26 comes out, we start to see some of the benefit of that going forward. There's some cost initiatives which will be coming in the second half of the year. The team's done a good job of making sure that we're maximizing efficiency where we can, so we don't have to put all the burden on our customers to absorb all that. So I think we're in good shape. The second half should be better and should be more offsets than what we saw in the second quarter, as we're just adjusting to it. But that remains consistent with that 30% assumption that we had going into the year.
Paul, and this isn't specific to GM, but I do wonder how you can have confidence to say, the third quarter is when we might start to see these efforts bear fruit, given that it feels like the tariff landscape in particularly dramatic periods can change day to day. And from where you're sitting as the CFO of General Motors, is your opinion that the current tariff structure, the current stance of this administration, does this make U.S. manufacturers, U.S. automakers actually be more competitive at the end of the day?
Well, I think over the long term, certainly we do believe that it can be a more rational and more stable industry for us across the board, and we're going to work through that. We've already announced significant plans to increase production here in the U.S. It started with the decision to increase the line rate and our production rate in Fort Wayne, where we'll produce another 50,000 trucks and SUVs on our trucks on that line going forward, and that'll hit us this year. So that's already taken effect. The changes that we announced earlier this quarter, we'll start to see those in about 18 months across the board. So, I think it clearly is having the intended result, and one that I think will be net good for us going forward over the long run. We are optimistic about bilateral trade deals, and as they work through, in particular with Canada and Mexico, and also Korea with our footprint there. But where we feel comfort in the fact that the auto industry is very important to us as well as it is to Korea. So we believe that they'll be able to work out a deal, and ultimately that'll be good for both countries.
What can you tell us about any future capital allocation? Is GM planning to do any share buybacks, especially in light of some of the cost reduction efforts you're taking in the second part of the year?
So capital allocation is one thing that I think we're really proud of as a team and what we've been able to deploy consistently. First, we invest in the business. We'll be investing $10 to $12 billion over the next couple of years. That will allow us to both improve and continue our great vehicle portfolio, but also these footprint changes that I mentioned earlier. But even with that, we're producing sizable free cash flow, and we're able to make sure that we protect the balance sheet as well as return capital to our shareholders, and we've established a pretty good track record for that. Earlier this morning, we announced that we've resumed share repurchases in the month of July. As of June 30th, we had $4.3 billion remaining under our authorization and strong free cash flow projected. So I think it's something that the shareholders can benefit from as well as we drive this efficiency into the business to ultimately help mitigate some of this tariff exposure. So overall, I feel good about where we are, and we're working hard for the shareholders.
Paul Jacobson, Chief Financial Officer of General Motors. We thank you so much for joining us this morning. All eyes on that auto industry. And coming up next, all eyes on railroads as well. CXX, Norfolk Southern, BNSF is reportedly eyeing a deal, and investors are sussing out whether it's one of the two. More on railroad M&A next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
BNSF, it's the railroad giant owned by Warren Buffett's Berkshire Hathaway, reportedly working with Goldman Sachs to explore a takeover of the rival. Let's get more details now from Bloomberg's U.S. Deals managing editor, Leanna Baker. So that is the rumor out there, right? And that's what the street seems to want to believe. Warren Buffett maybe not cooperating with that narrative.
Right. So we couldn't independently verify the info, and it looks like he threw a little cold water on the report. You know, Warren Buffett doesn't love working with bankers, paying that extra fee. However, it makes sense right now for all the different railroads to find a dance partner and probably use a banker to do so. So it's not crazy that all these railroads would have an advisor, since there was a report last week that Union Pacific, the largest U.S. railroad company, was in early talks to buy Norfolk Southern, which would create a transcontinental railroad and set off potentially a wave of consolidation in the space.
Yeah, can you drill down a little more here on how the dance card is going to play out here and how there are not that many of them, right? So do they all have to consolidate at some point?
It's a great question. So there's about 4 of these Class 1 railroads, as we call them, and there could be, different combinations. But from what analysts are saying, Union Pacific and BNSF, the bigger players, would have to be the buyers, let's say. They're also the West Coast players, and then the East Coast players, Norfolk and CSX. Those would be the ones they'd have to combine with. But we're not sure at this point, which ones will play out. But we have reported that